Warning: in this crisis, the US government will take all your money. The US dollar has been the biggest and safest place in the global market to put your money. However, its value is rapidly degrading due to the Federal Reserve's monetary policy, and it's also hurting your wealth in the process. When a massive financial crisis ultimately hits the United States, having cash as a backup isn't going to do much good. Diversifying your assets and moving away from the dollar is advisable in protecting your wealth because the paper currency will be one of the first casualties of this crisis. This will be a wake-up call for a lot of people, but it's the facts that we need to explore and think deeply about. Hi, and welcome back to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we begin, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. Now let's get to the video proper. The Federal Reserve has been enforcing its monetary policy, which has resulted in the rise of inflation. As long as the consumer price index remains below 2%, the Feds have no reason to stop printing more money, or as they may call it, quantitative easing. While this is going on, the Feds are disregarding what's coming. The issue is that when they continue to increase interest rates, they'll ruin the economy, but not well enough to curb inflation. For this reason, you should sell off all bubble assets that cheap money has fueled. Because even though it's cheap money, it may become substantially less cheap for a short period, enough for the bubble to burst. However, since inflation is relatively high and is degrading your money's value, you cannot rely on cash as a backup or safety net. Similarly, you cannot purchase bonds because they will eventually be converted to cash. Additionally, while you're sitting on your money, inflation is slowly but surely eroding its purchasing power, especially since the global consumer price index increased by 7% in 2021, which is the highest since 1982. But if we track prices in the same manner as in 1982, the world would have recorded an increase of 15%, making the situation worse compared to any single year in the 1970s or 1980s. In addition, since the Feds can no longer continue to justify their 0% interest rates, this marks the beginning of the end. They would have to increase interest rates, but unfortunately, the rate increases they are proposing are insufficient and would affect the economy later than anticipated. Moreover, the 7% inflation happening now is a direct result of the Fed's proposal of increasing interest rates. However, a 1 or 2% rate hike is insufficient. If we intend to slow inflation, we need interest rates greater than the inflation rate. In other words, interest rates need to increase by 10%. But that seems impossible since we've had trouble raising them by 5% because of our enormous debt. The Fed's money printing and stimulus efforts are largely to blame for our current debt crisis. Meanwhile, the Feds have set the stage for the next financial crisis by making it challenging to combat inflation. Even if they tighten their monetary policy to curb inflation, we will not have tight money. Instead, we'd have money that is slightly looser than before. Now, the issue is that making the monetary policy less loose is insufficient to prevent the bubbles in many assets from bursting, leading to a market crash, but not tight enough to reduce inflation significantly. As a result, inflation will continue to rise even if the Fed raises interest rates to combat it, leading to stagflation, which would force the Fed to change track and begin easing once more, even though inflation will soon be higher compared to when they started their tightening effort. Sooner or later, the markets will catch on to this truth, the dollar's bottom will fall out, and we'll be in the midst of a currency crisis that will quickly escalate into a sovereign death catastrophe. Furthermore, if the Fed allows interest rates to rise dramatically, the economy will collapse in a fashion that is even more catastrophic than the one that occurred in 2008. But this time, no one will be saved. Either everyone must suffer in the losses or the Federal Reserve lacks the fortitude to do so and continues printing money, in which case the dollar will lose value beyond recognition and hyperinflation will ensue. And so investors are getting out of riskier momentum stocks and moving into safer value stocks such as those listed in Europe, Asia, or even just plain old companies making money and paying decent dividends. This is where the money is. which is why certain stocks have risen by 10% to 20% this year, despite no news to justify the rise. On the other hand, all bubble stocks, including cryptocurrencies, have been falling in value just as US technology stocks have plummeted. Since the US is saddled with so much debt and is experiencing such severe inflationary pressures, it is imperative that you invest in real assets and dispose of paper currency issued by the country. As the entire economy rests on the shoulders of these artificially low interest rates, any attempt to combat inflation would lead to its complete collapse. Simultaneously, artificially low interest rates must be removed if inflation is to be remedied, leading to the collapse of all economic activity based upon them. Moreover, when dealing with inflation, it is essential to remember that creditors risk losing the most and will most likely be paid with money owed to them in depreciated currency. In this scheme, you wouldn't want to be a creditor based on the US dollars or even hold cash, bonds, annuities, or cash value of an insurance plan. You must invest in tangible assets such as shares in foreign stock companies with substantial dividend payouts. These dividends will grow in value as the dollar declines. This means they may charge more, bring in more money, and distribute more of that money as dividends. Additionally, the rising dividends will keep up with increasing living expenses. However, many investors in the US stock market aren't benefiting from dividends. Instead, they own pricey stocks that are declining in value. Likewise, bond investors aren't making nearly enough money because of historically low interest rates. Similarly, if you're receiving 1 or 2% interest and inflation is 9 or 10%, you're moving in the opposite direction and will soon be unable to sustain your standard of living. And at the moment, bonds carry a higher risk than stocks. It's a shame since bonds are intended to be a safety net for investors who wish to avoid the stock market's volatility without sacrificing any returns. Fixed interest loans should guarantee repayment from the borrower and provide consistency in terms of interest earned. However, the difficulty is that everybody who buys bonds in the current market is overpaying. Due to Fed-induced price inflation, you have to pay an absurd amount for a return just over zero. Bond prices fall as interest rates increase, but the money you're supposed to get from those bonds is worth less and less as inflation eats away its purchasing power. Thus, looking at the cash flow generated by the stock, similar to how one would evaluate the worth of a piece of real estate by comparing rental revenue to running expenses, is one foolproof method for determining whether or not a stock is a worthwhile choice. Understanding your share of the profits and your return on investment is essential information for any business owner. Conversely, if you hold on to your stock forever and never sell it, your return will be the dividends you receive. Capital appreciation can also occur if a business generates enough cash flow to repurchase shares of stock, distributing a portion of its earnings to shareholders. Additionally, stockholders are entitled to a portion of a company's earnings, even if they aren't distributed as dividends. So it's essential to consider both the dividend payout history and the company's ability to generate future profits before deciding whether or not to invest. The good news is that we can diversify our assets across a variety of stable companies throughout the globe. However, it's important to note that investors must move swiftly while they still can, because as the dollar declines in value, the cost of owning assets like stocks will rise. Currently, US stocks are very expensive, meaning the dollar will likely depreciate in value, but foreign stocks will prosper in the coming years. Techniques that didn't work in the past will work for foreign stocks. Overall, to preserve your wealth from the potential US economic crisis, it's vital to diversify your assets away from the dollar and focus on value instead. The American economy is likely to be in a terrible position, and being prepared is key. It appears that we have reached the end of this video. Thank you for watching this far. Please subscribe and give a like if you enjoyed it, and comment your thoughts below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe, and I'll see you on the next video.